Supermicrocomputer just reported earnings. Today we're going to be seeing where it could be headed in the future and what it's actually worth. So we've got a price per share of $732, a price to earnings ratio of 41, a market cap of 42, almost 43 billion, and an enterprise value of slightly above that, 42.9 billion. There's a cash debt ratio of 1.14, so for every dollar of debt they have $1.14 to pay down those debts or expand the business. Looking at the profitability, the gross margins are currently at 15.97, just above that median for the last 10 years. Operating margins sitting at 9.72 with a high of 10.6. Net margins just below their maximum with 8.88, and free cash flow sitting at the lowest they've had in the last 10 years. I use those to tell me about the profitability of the business, but for management strength I use ROE, ROA, ROIC, and ROC. And for these, I see pretty solid green bars both versus the industry and their historical performance. Those are pretty strong management returns. Their price to earnings ratio did shoot down a lot recently. The last time I did a video, it was sitting right around this 80 high, and now it's still double what their median is, with 41 currently, but down about half of what it was before. So not cheap based on its 10-year range, but getting closer to it. Looking at their financials on a trailing 12-month basis, actually it looks pretty steady with net income up and to the right, revenue increasing as well. In a quarterly format, we can see some dips here. So not quite as steady as some businesses where every quarter they're going to be earning that steady revenue and they know they're going to be more profitable each quarter. Their debts did spike up, but their cash pile has increased. Pretty big share sales, so not exactly what I want to see. And the bulk of their business comes from server and storage systems, mainly in the United States, followed by Asia, Europe, and other countries. So one business segment, mainly in the United States, selling lots of shares recently to raise capital, but also decreasing shareholder value by increasing the float. We can see revenue is up and to the right, and it looks like net income is growing alongside it, even though fairly small margins compared to the amount of revenue that they have. Cash is outpacing their debts. Their price to earnings ratio is just about double of their 10-year average and half of their maximum. Their management strength looks pretty strong. Their margins are some of the best they've achieved in the last 10 years, or close to it, but still pretty bad sign with free cash flow and fairly low margins. Single-digit margins for operating and net, even though those are some of their better achievers. But to see what the valuation looks like, let's run a DCF. So in the DCF, we have some decent predictability for the business. And looking at earnings per share, there's currently about 23% growth priced in for earnings per share on the next 10 years. And in the last 10, that's exactly what they've achieved. And we do see that in the last 5 years and 3-year averages, they've actually achieved higher growth rates than that. So if you think they're going to accelerate that growth to maybe 25 for the next 10 years, then a fair value is closer to 833. If you think they'll even hit 30, we could see that 1,000 plus mark. And on a bearish estimate, if they slow down to 20, then we could see even lower. So based on earnings per share, it actually does look like it's fairly valued if you think they're going to match their 10-year past growth rate. And if you think they're going to accelerate, then it could be even undervalued. But I'm definitely going to be keeping it on my watch list and checking in for when it does become cheap or a better buying opportunity. That being said, this is my take on SMCI. If you like these type of videos, leave a like, subscribe to the channel if you're not already, and I'll see you next time.